Good afternoon and welcome to the weekly macroeconomic session for this Friday the 22nd of May 2015. Hopefully your week's been a good week on the market. Today sitting with me as always is Jeff Saffer, head of the Elite Investors Club. Welcome to you, Jeff.
Thank you, Dave. Hello everyone.
How's your week been?
Fairly busy.
Fairly busy. There's been a fair bit of news this week on the markets, both locally and overseas. So that's what we're here to talk about. So let's get stuck into things. But first, our disclaimer, and the disclaimer states that the content of this presentation or any other Elite Traders Club or Elite Investors Club material does not constitute a recommendation, nor does it take into account your investment objectives, financial situation or particular needs. So please consult your licensed advisor before taking any action based on the content covered in today's session. Right, that's out of the way there, Jeff. Let's have a look at the news that came out this week on the market. It was a fairly busy week. We had the monetary policy meeting on Tuesday with the RBA there. We had consumer sentiment coming out. We had a raft of data in the US that was interesting to see what came out there. Also some announcements in the Eurozone that certainly had an impact on the German markets. Some more data out of China, and today actually monetary statement coming out of Japan. So Jeff, just your view on monetary policy from the RBA and consumer sentiment at the beginning of the week.
Yeah, look, these are a couple of really interesting ones. First of all, the minutes from the RBA's meeting a couple of weeks ago, they cut rates to 2%, and they also dropped commentary that they were looking to cut rates further. And everyone, myself included, took that as a sign to say that the RBA was done cutting rates for the moment, for some time. What's interesting is that the minutes have come out this week, and they said a few things really. First of all, that the picture is still quite weak.
Yep.
Inflation's under control. Job growth is going to be slower than expected. Unemployment's going to stay high longer than expected. So obviously weak indicators. And suggested they might have to do something about it.
Yep.
And they essentially left the door open for further cuts. They said, look, they didn't say anything about cutting rates further in the May statement, but they didn't do that. They did that they said, look, it's better we don't make any comment for now.
Yep.
So the whole point of that is that there's still some chance that if things don't improve, we could see some more rate cuts.
Right. Okay.
I'd still say rates are on hold, in my opinion, at the very, very least until August.
Yep.
Wait for the next round of CPI data. I'd be super surprised anything before then.
Yep.
And probably still not until, you may not see anything until November, but the door is still a little bit open.
Yep. So what do you think of the main thing that the RBA's got its eye on to think about moving those rates?
Yeah, look, I guess they're looking at many things. The most important things are probably the unemployment rate,
Yep.
And also business activity.
Right.
Those are the two main things they've got their eye on, and inflation as well, as always.
Okay, and we had consumer sentiment out there, the WBC, that's the Westpac Bank Consumer Sentiment Survey.
Yep.
6.4% coming in versus the previous minus 3.2. What do you make of that?
Yeah, so this is, I mentioned this last week, before the data came out. This was a big one because this was going to be the first consumer sentiment data after the budget.
Yes, that's right.
So everyone's seen the budget, and I did suggest that we would see a much better reaction than last year. So last year, a really tough budget, and consumer sentiment actually took a massive, huge hit and took months and months to recover.
Yep.
This time round, the budget was a lot softer, a little bit more cash was being splashed around, and certainly less money being taken away and things cut. So that's obviously a good sign. So a softer budget, and of course, lower interest rates,
Yep.
fairly low oil and petrol prices. Put that together, and a nice cocktail for fairly confident consumers.
Yeah, okay. So over in the US there, Jeff, just recently we had flash PMI coming in at 53.8 versus 54.6. So that's still above 50, which means expansion.
Yes.
What do you make of that, given that the economy over there, supposedly these sort of indicators showing growth in the industrial area, but we also had got some other conflicting information, I suppose, in terms of consumer sentiment, which will talk about in a moment as well, which is coming up this following week. Sometimes we mentioned last week that the consumer drives a lot of what happens in the US, so it'll be interesting to see how those figures come out in this following week. PMI there, Jeff, what do you make of this?
Yeah, look, those two are obviously missed expectations. I've been telling my members for probably a month or so at least that the strong US dollar is hurting the manufacturing sector over in the US. So obviously a strong US dollar means that American products are more expensive for people in other countries.
Yep.
So the manufacturing sector in the US is struggling a little bit at the moment.
Right.
And I think that's more than anything just a reflection of the strong US dollar.
Yep.
And just on that as well, we've got some GDP figures coming out next week, which we'll talk about, and I'll link that a little bit later.
Sure.
Over in Euro, you mentioned obviously the economic sentiment, and this is a very important indicator that I look for Germany and for Europe as a whole. It's a survey of German investors and analysts about the outlook of the economy, and that's come in well below expectations. Still very positive, but took a big hit. So that's a bit of a turning point, a bit of definitely a negative sign there. So I'd be a little bit less confident about the German market now.
Yep.
Over in China, we had flash manufacturing PMI, which missed expectations. Now, I tell my members, and I've said in these videos, this is probably the most important number coming out of China.
Yep.
Look, this has been weak for the last few months.
Mm-hmm.
Below, you mentioned that 50 level earlier.
Right,
so
yep.
the 50 above 50 suggests expansion coming up, and below 50 suggests contraction. So we're in that softening contraction phase. So it's not a great sign for the manufacturing sector in China, which is obviously so important. So some I guess negative signs out of the US, negative out of Germany, and a soft sort of negative number out of China. In Japan, the meeting is supposed to conclude today, and the statement come out today. As of recording this video, there's nothing out yet.
Okay.
And we're probably not expecting any change. I'm not expecting any change to the current course.
Yep.
But we've got actually some data coming out next week, which might impact moving forward.
Okay, well, just while you're sitting next to me here, Jeff, I just brought up a chart of the German market here, and I've just highlighted there in the circle. This was the evening when we had the economic data coming out, so the Eurozone confidence level, if you like, and it was a big miss, which we saw. It was down at 41.9 with versus expectations of about 50 there, and the market literally went up about 2.5% on that particular day over in Germany. Jeff, just explain for everybody out there, why is it that bad news, if you like, the feeling of consumer sentiment over there in the Eurozone was such a positive thing for the markets?
Yeah, I think if you think back over the last probably 5 or 6 years, obviously the markets have put on a stellar run.
Yep.
In Australia, to a reasonable extent, but certainly in the US and hitting record levels, and in Europe we've seen a nice big turnaround in their equity markets. And obviously the number one thing driving these gains, not solely, but a lot of the contribution has come from low interest rates.
Yep.
And we've got low interest rates because we had a GFC and the world showed no economic growth, went backwards, went into recession, and we had disastrous financial markets. So because of that, the world went into this emergency situation with low interest rates, and low interest rates are really, really good for the markets and good for companies. So what we're getting at now is at some stage, all these countries around the world are going to have to start raising rates, and you do that when you actually get good economic news. You see signs that the economy is strengthening and things are safe enough that we can raise rates and the economy won't collapse. So essentially, if you see some really good economic news, the market thinks, oh no, we might see some higher rates coming up. And on the other side of things, if we see some really bad news, they say, oh, great, the Reserve Bank, Central Bank, whoever it is, will leave rates on hold or maybe cut them. So we're in this definitely situation of bad news is good news, which is sometimes it leaves you scratching your head.
Yep.
And it doesn't make a lot of sense. And if I get out my economics textbooks, professors will tell me that's not how the market works. Good economic news makes the market go up, and vice versa. But it's very, very clear at the moment, and very much in the US as well.
Yep.
Any good news, the market actually tumbles.
Yep.
Because they're worried the Fed's going to start raising rates.
Yep.
So that's as simple as it gets. Bad news is good news.
Yep.
In pretty much every single major market at the moment.
So really here the prospect of ongoing extremely low interest rates for the
Yep.
market. And the market's like low interest rate environments. So, okay, thanks for that, Jeff. Just having a quick look here at our local market. I've just put on here obviously our market risk profile, which we talk about on Monday mornings. We're down below 80 for the time being. So we've gone from a low risk into a moderate risk market environment. Interestingly, since the lows towards the end of last year, I've just put on a Fibonacci retracement on this particular move from the lows to the highs, and you can see that a couple of days ago the market's come just back to that 50% retracement level, which is pretty typical of your normal sort of ebb and flow of the markets. Now, I would like to see, we saw a nice day yesterday. I mentioned last week that it would be nice to close above 57.50. It doesn't look like we're going to get there this week, but hopefully next week, if we get off to a good start, then hopefully the market can start to turn around and move back up, and at the same time sort of drag us more back up into a lower risk environment if that stochastic can move upwards there. So that's the Australian market for this week. Over in the US there, you can see the stochastic there is still above 80. It's been above 80 for a long time. By comparison, when we talked about the movement of both the US markets and the Australian market since the beginning of the year, the Aussie market really jumped out of the gates, put on about 10% in a very quick amount of time, and since then has given sort of half of that back. The US market really just sort of dawdled sideways within a range for quite a period of time, and as a result was underperforming in comparison to the Australian market. I've just highlighted there the range, if you like, that the US market was moving up and down between. Just recently, just starting to show signs of improvements there in the market, with the range now expanding outside, or the market now sort of expanding, moving outside of that range there, albeit not terribly convincingly. The last, I think the last 5 candles there, all not showing a lot of net sort of movement. The range is small. The bodies of the candles are quite small as well, so not a convincing move at this stage. It would be nice to see some bullish candles come through over the course of the next couple of weeks, and I think the market over there can move on to better things. But we'll just have to wait and see. I'm not predicting it, but at this stage it certainly is starting to outperform our local market in the last few weeks. This next week, Jeff, we've got again, there always seems to be important data coming out, and here you've highlighted some important ones. In Australia, we've got the MI leading index. What exactly is the MI leading index, or should that be lending index?
No, it is leading index.
It is leading. Okay.
So what it does is it actually so an index is something that tracks a bunch of other things in one number. So what this does is it actually looks at a bunch of different economic data pieces and puts them together. It's almost like a summary, and it's supposed to predict. It's a fairly accurate, mind you, number, sort of predicting economic activity in the next sort of 6 to 12 months. That's why it's a leading index.
Yep.
It's leading, up to and before, sort of almost like a predictor of what's going to happen. I like it. It has its strengths and weaknesses. It's one really interesting to look at, because in one number you can just get a summary of everything that's going on, so everyone can save themselves from listening to all of our webinars and just look at this one number.
Right.
The problem with it, so that's why it's really good. The problem with it, though, is that by the time the leading index comes out, a lot of the data points have already been released. So it's not really new news that it doesn't really move the market, because it's a bit, you've already the market's already reacted to all the individual bits. But it is a really nice, just a practical number to be able to look at and get a very quick idea of what we're facing. So I always like to see where that turns out. Private capital expenditure quarterly figures is going to be particularly important, considering we've got a major mining slowdown, mining sector slowdown in Australia, and we're really hoping that the rest of the economy is sort of going to pick up that slack. So it's a number that will be watched very, very closely by the RBA. In the US, a few bits and pieces. You mentioned consumer confidence has been at very high levels recently, although it's a couple of months it's sort of missed expectations in the last few, and I think part of that has actually come from increased expectations that the Fed's going to start raising rates, and that sort of scared everyone. Core durable goods orders is a very important one, really gives an idea of business activity and business confidence as well. And that's been very shaky. You need to do a bit of work on that because in terms of durable goods it includes things like aircraft and things which and defence spending, which is a bit lumpy. But if you look at the underlying figures, American companies have not really been investing in sort of long-term assets that convincingly recently. New home sales, you mentioned the importance of consumer confidence. US property market is rebounding. You see more strength in that. Consumers will be happy. And prelim GDP, we've already had some what we call advanced figures, so like an early release for the first quarter, which is very disappointing. This will probably just confirm that. And the reason so it's not really anything particularly new. The reason I bring it up now, and I mentioned it earlier, is that the US had a particularly sort of soft first quarter. The Fed has actually come out and said they thought the first quarter was a temporary issue, partly because of weather and things like that. I think actually that the US, we're seeing some weakness in the manufacturing sector because of the high US dollar. We're seeing consumer confidence stalling a little bit. I'm putting it out there that I think the second quarter GDP will actually underwhelm as well. So we won't know until the end of July. But a couple of months out, there you go. You've got the GS leading index, the Jeffrey Saffer prediction, that I think we'll see a disappointing number in the second quarter GDP. Sort of so far the signs are not that great.
So do you think that's going to have an impact on the date for raising of interest rates? So there's a lot of talk about, when is the Fed going to raise rates? And if you're suggesting that these figures are going to come in and potentially be weaker than what the market's forecasting, then does that mean the Fed's going to have to sit on their hands for a little bit longer? Look,
I mean, the Fed has really changed its language in the last few months. Really basically to warn the market that the rate rises are coming. They had basically set the scene that a rate rise would be as early as next month. Their minutes came out during this week pretty much saying that's not going to happen. Now everyone's expecting September. And I think what we'll find is that we get closer to September, people will start shifting to December. And certainly if we keep on getting some weak signs, the Fed is pretty keen to start soon, but they will have to push it back.
And Japan, why have we got Japan mentioned this coming week, Jeff?
Well, I mentioned earlier, obviously, that they have their monetary policy statement being released today. Their policy has been very much of the quantitative easing methodology in order to stimulate the economy. Now, Japan's quite an interesting one. They've had been facing deflation for virtually 20 years, so asset prices have struggled to go up. Their economy's been very stagnant. So they've initiated huge stimulus in the last 12 months, and they're trying to push up inflation. Typically, countries are battling, try and bring inflation down. Japan's really trying to pump it up. And so around that, two of the things that they're looking at, I think retail sales will give an indication of the measures that they've implemented are actually having an impact on the economy. And obviously inflation they're going to be keeping an eye on. Realistically, they're going to want to see a higher number, which is very, very rare. So this current monetary policy statement, I don't think you'll see anything different. In fact, you probably won't see anything different for a little bit of time. But these are some really important things to look at. If we start seeing some signs of life, some spending, some activity, some inflation, then that the sort of stimulus will be pulled back,
Yep.
and the huge run up we've seen in the Japanese market, the Nikkei,
Yep.
will probably come to a screeching halt.
Yep. Okay. Because that's been.
And until that happens, I mean, it's one of those make merry while the the rising sun, while
Yep.
the sun shines. And I think there's probably still more gains ahead in the Japanese market, but at some point, when they do pull things back, I think you could see quite a major correction there.
Yeah, because obviously the Japanese market has put on a fair bit this year, and it's been one of the stronger performing markets. So, Jeff, in terms of these markets that are starting or have potentially got some stimulus behind them, the European markets and obviously up to this point the Japanese markets, for clients out there who are wanting to get exposure to those markets, we don't have data feeds on Japanese stocks or European stocks on Beyond Charts. What would be the easiest way for clients to get exposure to those markets?
Yeah, look, there's probably two ways that I would suggest. I mean, one would be through an ETF.
Yep.
An ETF is just, if you know what a managed fund is, where you invest in sort of an asset that invests its money in various investments. And so an ETF is like a managed fund that's just listed on the market. So instead of sending off paperwork to the fund manager to get in and out, you can just sell them like any other share. That's the easiest way. So if you've got a CommSec or E-Trade account, if you can trade BHP, you can trade the Japanese market, essentially. The other option is through a futures contract,
Right.
which is a bit more complicated.
Yep.
Maybe you could do it through CFDs,
Yep.
but it's a little bit, I wouldn't say trickier, it's a little bit different, and not everyone's got a CFD account, etc. So
Sure.
those would be the two ways, either sort of a futures contract or just an ETF.
An ETF. Yep. Okay. Well, that just about wraps it up for this particular week. Thanks for being with us. Don't forget to keep an eye out in your inbox for the weekly analysis session on Monday morning, the webinar invite for that. In the meantime, thank you very much for joining us. Have a good weekend, and we'll catch up with you all on Monday morning at 9 a.m. Bye for now.
See you.